Okay, welcome everyone. This is my first live video on YouTube. And I said, you know what, let me try doing live videos instead of pre-recorded videos, just because my schedule and trying to service clients and, show properties and all that stuff, it just gets crazy throughout the day. I don't get to schedule my videos and I have to edit them and put them out. So I said, one take, let's just get it done. So leave your comments down. If you have any questions throughout this video about anything, I'll try to answer and see what I can do. But today, let's talk about mortgage rates, where we're seeing that they're going to go. So far, we've had a rate cut. Now we're 2 weeks into the rate cut, and we have more rate cuts coming up this year. So the Fed's already signaling that we should have another rate cut coming up by the end of the year. By the end of this month in October, and then we should have another one coming in December. And so far, what we're seeing is pretty much on track. As I've been saying, that after the rate cut happened, the rates were going to be jumping up and not actually coming down more, which we've seen it happen. So when the rate cut happened, we were at, give or take, around the 6.1% interest rate for 30-year fixed mortgage. FHA was hovering around 5.75. And I'll share the screen with you right now today. So today we are at, right here, 30-year fix is at 6.32%, 15 years at 5.84. Then you have your jumbo, and your 30-year FHA is looking at 6.03. So this is on par. And if we check this map out right here on the bottom, it shows us that last year in 2024, when we also had rate cuts first hit us in September, and following that, right about here in October, you can see it was 6.63. So we're actually doing, year over year, we're actually doing better on the rates than we were in 2024. So, but again, it was the same thing. The rate cut happened and the rates jumped up, and then gradually they came down again. So it's more of the spread that needs to get lowered, not the rates themselves. Because remember, when the government cuts these rates, so when the Fed is cutting these interest rates, it doesn't impact the mortgage rates directly. This is the Fed saying, hey, we're going to lend the big banks, for example, if it's Chase, Citibank, whoever it is, that are borrowing money from the federal government. That's the rate that they're borrowing at. Then they add in their spread. So their spread is their profit margin that they add in, which then the consumer receives. And then you see, 30-year fixed at 6.3, 6.5, whatever it might be. And then you also have the 10-year, that's where it gets affected. So we usually look at the 10-year treasury, and then add the spread. The banks will add the spread on the 10-year treasury. So today today we had a big tweet come out from Trump that really tanked the market across, which we'll talk about in a few minutes. But you can see that today the 10-year treasury is at 4.062. And then if we go 1 year from here, we can see the last year was roughly around the same, it was 4.037. So, and again, the reason the rates were higher last year post rate cut was because the spread was a lot. So the spread is getting better year over year as well. So, and I've been telling that to my clients also. Right before the rate cut was the perfect week to lock your rate. And if you got to lock it in, you hit a really good interest rate where you might not even need to refinance for another year, maybe year and a half, because just the cost might not be enough compared to the savings to refinance that close. So, but now I would recommend, if you're in contract or you're looking to go into contract, maybe give it another week or 2 weeks. I believe these rates should come back down. With more rate cuts on the way, these rates should definitely then impact, and we should start seeing that 6%. And below 6% is where the sweet spot is right now. That's when we see the uptick in refinances, mortgages, buyers out and about, and looking at properties. So I'm predicting this winter season is going to be a very busy season in terms of real estate, because the rates are starting to come down, and they are actually pushing more than just a quarter base point, because we want to see at least half a point cut, not just 0.25. So if we see a 0.5 cut or as much as a 1 point cut on these 10-year yields, and which will then indirectly impact the mortgage rates and the spreads come down, we're definitely going to see a boom in the real estate market come this winter. November, December, January time. So we'll see a massive boom come up. So that's where we are about rates. And in terms of houses, I mean, so I service the 5 boroughs here in New York City, Long Island, and we are not seeing a slowdown in terms of real estate sales and transactions or anything. I mean, yeah, it's the normal influx of the seasonality, but other than that, you definitely have properties that are coming on the market that are priced well. They're moving, as fast as they can within about 2-3 weeks. And then you have properties that are priced above the market where maybe the seller's still thinking this is 2021 and I can get over asking, and they haven't adjusted for the market of today and they're still thinking it's 3% interest rates, 4% interest rates. Then those houses are sitting on the market for at least 6 months, 180 days, sometimes even 90 days. And then they'll start seeing price reductions. And again, it's not, the seller cannot ultimately determine what the sale of the price of the house is going to be. It's the buyer. It's the market determines the price. So until you have that price discovery, going in, we educate the client like, hey, this is what it is. But if the client is adamant about listing a house at a certain price, then, we say, okay, you know what, we can test the market. And as we go along, you'll see that this might not work and you might not get this offer that you're looking for. And we always tell them like, this is what you might get, just because we've been doing this for so long. We understand where the market is, what the price our sellers are going to get in this market in the range. I mean, we can't tell to the dollar or to the penny, but we can definitely give them a healthy range on where the price is going to be for that property. So properties are still moving, and the sellers that need to sell are eventually coming down to the price that the market is going to give them, and they end up selling. And what I always explain to my sellers is you rather price a property the first time, because if you wait 6 months and you're on the market, then it just makes your property look bad as if something is wrong with it when there might be nothing wrong with the property. So that's where we are with our real estate. It's not bad. And but let's move on to this. What the big news for today was President Trump, and he shared this tweet that got the whole market riled up. I'm going to pull this up right here. So he said, some very strange things are happening in China. They're becoming very hostile and sending letters to countries throughout the world that they want to impose export controls on each and every element of production having to do with the rare earths and virtually anything else they can think of, even if it's not manufactured in China. So it's pretty long. I'm not going to read the whole thing, but basically what he said is China wants to control the rare earth materials that are leaving their country and going into other countries. And they want to basically micromanage. They want to see what's happening. And he doesn't want that. And he says that other countries, and they're bullying basically all the other countries as well, that they want this policy with everyone. So he is threatening to put tariffs back on the table and to tariff the Chinese companies and the imports that come from there. So that got the market really wild up today and just sunk everything down. Everything got pulled back. But remember, the market's been pumping all year. It's at all-time highs every other week. So this was kind of, if you follow the right people and you're looking at information and you're tracking it, you'll know that this was gonna happen. Whether he tweeted this or he tweeted something else or anything would have shook. The market was so delicate that anything would have pulled this market back real fast. And however, it wasn't really that bad today. I'm going to pull up the heat map over here. So this way we can check out the heat map on the stock market. So everything obviously was red, and except for a few. So we got some McDonald's actually was in the green today. But pretty much everything tech-wise was just pure red. SPY was down 2% today. So this is what happens when everything is just increasing, and then just like the littlest thing can just retract a lot of gains. So account for this when you build your portfolios. Account for some pullbacks. Don't over leverage yourself. Don't buy into the hype, into meme stocks and stuff like that, especially if you're just looking to grow your portfolio and everything. So that's concludes today's video. I hope you guys like it. If you have any questions, post it below. If you would like me to cover anything else in the future videos, I'm going to try to do these at least once or twice a week. And it's just so much easier to just pop the camera on, go live, no editing required, and just say what I have to say. Okay, I'll see you guys on the next one.